Welcome to This Explainer. Okay, today we're going to tackle something that sounds incredibly dry, but is actually a massive deal for any global business, IAS 21. We're going to take these really dense technical accounting rules and translate them into a totally practical playbook. If you've ever found yourself wondering how on earth multinational giants keep their financials straight while dealing with, 10 different currencies swinging wildly every day, you are in the exact right place. Let's get into it.
Quickly, here's our roadmap for This Explainer. We're kicking things off with the core foreign exchange challenge, then figuring out how to find your functional currency, recording daily transactions, translating that into a presentation currency, handling entire foreign operations, and wrapping up with the final disclosure rules. Boom! Let's go!
Part 1, the Foreign Exchange Challenge. We really need to establish the baseline problem of doing business across borders.
So how do businesses actually bring order to this multi-currency chaos? Think about it. When a company does business overseas, whether it's just buying parts or running a whole separate branch, they desperately need a system. Without a solid rule book, fluctuating exchange rates would just completely distort economic reality. I mean, you could have a rock-solid, highly profitable month operationally, but it looks like a total disaster on paper just because a currency exchange rate tanked on a random Tuesday. We can't have that.
And that right there is exactly why IAS 21 exists. The whole objective is to prescribe precisely which exchange rates a company should use and exactly how to report those wild currency effects in the financial statements. It's about bringing standardization and, honestly, a little peace of mind to a ridiculously volatile financial landscape. Moving to Section 2, finding the functional currency. Because before we record a single invoice, we've got to establish our financial home base. By definition, the functional currency is the currency of the primary economic environment where the entity operates. Now, the absolutely crucial thing to remember here is that this isn't just the currency of the country where your headquarters happens to be legally registered. No, it's the currency where the business actually generates and spends its cash. It is the operational lifeblood of the company.
The standard actually gives us a really important underlying philosophy for this. It empowers management to use their own judgment to pick the currency that most faithfully represents the real economic effects of their transactions. So if the signs are pointing in a few different directions, it all comes down to economic reality. We're prioritizing real substance over arbitrary legal forms.
Okay, to make all this math work later on, we need to lock down a strict boundary between two vital concepts: monetary versus non-monetary items. Monetary items are things fixed in actual units of currency, like your cash, your receivables, your payables. Non-monetary items, on the other hand, don't give you a right to receive fixed cash. We're talking about physical assets here, like inventory or property. You really want to keep this strict divide in your head because it changes the whole ballgame when we start translating numbers.
So how do you actually pinpoint that functional currency? You've got to look at a few primary indicators. Ask yourself, what currency is actually dictating your sales prices? Which country's regulations and competitive forces are pulling the strings? And what currency are you using to pay for labor and raw materials? These everyday, on-the-ground economic realities are what ultimately dictate your functional currency.
All right, Section 3, recording daily transactions. Now that we have our home base firmly established, let's look at what happens when the business actually starts making global moves.
On day one of a foreign transaction, let's say you're buying a ton of inventory from overseas, the rule is actually incredibly simple. You just apply the spot exchange rate exactly as it stands on that specific date. You're just capturing the reality of that exact moment in time.
But when you hit the end of the reporting period, things get a bit more complex, and it all depends on those item types we just talked about. For your monetary items like cash, you got to update them using the closing rate at the end of the period. But for non-monetary items, like that inventory we bought, assuming it's measured at historical cost, you just leave them alone. You stick to that original transaction date rate. Now, if they happen to be measured at fair value, you use the rate from the exact date that valuation took place. Simple rules, but you absolutely have to follow them strictly.
Now, you might be wondering what happens if the business just completely pivots. Well, if the underlying economic conditions driving a business permanently shift, you actually have to change the functional currency. But and this is key, you apply it prospectively from the date of the change. You don't go back in a time machine and rewrite history. You simply adopt the new exchange rates from that day moving forward.
Moving into Section 4, translating presentation currency. We are zooming out to the macro level now for year-end reporting.
This is a really fascinating distinction. A company can actually present its financial statements in literally any currency it wants. That is called the presentation currency.
In the real world, this usually means taking all that operational data we just gathered in our functional currency and translating it into whatever currency the shareholders or regulators want to see.
So how exactly do we pull that off? Let's walk through this three-step recipe. First, you translate all assets and liabilities at the closing rate. Second, your income and expenses get translated at the transaction date rates, or an average rate if it's reliable enough. And third, because you're using different rates for the balance sheet and the income statement, you're obviously going to end up with a gap. To fix that, you recognize all those resulting exchange differences in other comprehensive income, or OCI. This keeps those wild swings from distorting your actual operational profit and loss.
Section 5. Handling foreign operations. We've mastered the single invoice and the whole company translation, but what about owning an entire branch in another country?
When it's time to consolidate, the parent company faces a big question. Is this foreign operation just a pure extension of the parent, or is it basically running its own show in its own local currency? To figure out their level of autonomy, you have to check a few key indicators. Are they mostly self-sufficient? Are they doing a lot of transactions directly with the parent company? Are they out on their own? And, crucially, can their local cash flows actually service their own debt without needing a bailout from the parent? If they are highly autonomous, they are probably going to have their own distinct functional currency, and you'll just use those translation steps we just went over to roll them up into the final reports. Oh, and a quick but vital rule here. If that foreign operation happens to use a different reporting date than the parent company, 3 months is the absolute maximum allowed gap between the two dates. Anything beyond 3 months and the financial data is just considered way too out of sync to give anyone a faithful representation of what's going on. Finally, we've reached Section 6, Disclosures and Final Rules. Because transparency is the whole game here. IAS 21 mandates some very specific disclosures so that anyone reading these financial statements knows exactly how currency fluctuations messed with the bottom line. You have to be super clear about what hit your profit, what got parked over in comprehensive income, what your actual functional currency is, and, if you're presenting in a different currency, exactly why you chose to do that. It is all about giving investors total transparency. It is also definitely worth noting an important boundary line here. While IAS 21 perfectly handles all the accounting translation, it totally washes its hands of the tax implications. Any resulting tax effects from these currency shifts are handed straight over to be dealt with under a totally different standard, IAS 12, income taxes. So, to bring it all together, by really grasping the why behind these rules, monetary versus non-monetary, functional versus presentation, you ensure that your financial statements actually reflect global economic reality, rather than just accounting fiction. You now have the ultimate playbook for global financial reporting. But it leaves us with one big question. Are your current multi-currency systems masking hidden financial risks, or are you truly ready to apply this level of clarity to your own complex operations? Thanks so much for joining me on this explainer, and keep learning.